Hello, founders. Welcome to Startups.com. We are live. We're coming to you every Tuesday, Wednesday, and Thursday. Tuesday, we do pitch decks. Wednesday, we do traction hacking and revenue acceleration. Thursdays, we have some fun. We do some AMAs. We ask all these questions. We kind of gather all your questions that we've been gathering from the internet and different places where people are asking us the most common questions. I have here with me my partner in crime, Wil, 9-time founder, 5 exits, founder and CEO of Startups.com. And Wil, I would be remiss if I didn't say this show is brought to you by us at Startups.com. Here's our website. All of you who are checking us out and who are joining us live or we're going to be watching or recording this, make sure you check out Startups.com. A lot of free resources here. And it's just a really great central spot where we want to help you. Sometimes we call it the Forever Accelerator. We just want to be your friends forever and help you along the way. Wil, what's your invitation for everyone to join us at Startups.com?
A lot of folks come here. Part of the challenge they have when they first get there, they get overwhelmed. They're like, there's so much stuff here. And honestly, if we flip it, and Ed, we talk about like from a product perspective, it is a challenge for us because there's just a ton of stuff here. And this isn't me saying, oh my God, we have so much stuff. It's like, people get here and they just get overwhelmed. Like, where do I start? And I always tell them, jump in a workshop or jump in one of our courses. And actually, even this video is a reflection of how we walk people through problems. We take really complicated stuff and we make it really simple. And most of the stuff sounds really complicated, not because it is, just because you haven't done it yet. So give us an opportunity to break down some of these questions for you and show you that it's really not that hard.
Could have said it better myself. Since we're answering all your questions, use the Q&A box or use the chat to ask questions, whatever's on your mind. Feel free to completely take over and impose your will and your agenda with your questions on our conversation today. We're going to prioritize whatever comes through the chat. But what we're going to do something kind of off the beaten path today. We're going to talk about how to start a startup and raise pre-seed with no money in 2025. We're going to do a tier list. And I did a little research. I was thinking about this, and Wil, let me set it up for you. Here's what we got going on. So we have a lot of founders that don't have deep pockets to go out and, plunk down whatever, 10, 20 grand on an MVP or spend on investor outreach. And they're thinking to themselves, how do I do this completely if I was broke?
Right.
Which is what I did as an exercise. So here's what I did. Well, what I said was, okay, let's pretend that I am broke. All right. I ran this thought exercise. So Wil, I'm going to challenge you to say, let's pretend you're broke. We both been there, truth be told. So we know what that's like. Yeah. And what I did was I thought about all the things that I know founders do that are low difficulty, low reward in terms of going out there and starting a startup with no money and trying to raise pre-seed, because I know that's a common thing. And then I ranked it to S tier, high difficulty, high reward, went through that. Now, what's important for those of you who are in the audience, feel free to ask any questions because I'm just looking in the audience and I know for a fact that we've got people in our audience who are in that situation where they don't have huge budget.
Yeah, most people.
Exactly.
Yeah.
So I'm going to just start you off, Wil, and I'm going to set you up and I want you to kind of judge my tier list and how I went about it. And we can discuss it. And then, you can make your own tier list in just a moment. So the first thing that founders do is what I call hopium pitch decks. Okay. And I'm putting this in the F tier. Let me set it up. You tell me what you think about it. I know a lot of founders, they say, you know what? I heard that if I just put a pitch deck together, go to investor, he's just going to give me money on my idea. Kind of like a back of a napkin type scenario, like it was 1999 all over again type thing. And I'm going to just put this moonshot idea, put it all together, and then I'm going to hope that an investor sees it and says, you're amazing. Let me give you some money just to get started. Wil, how often have you seen that work? Because, truth be told, sometimes it does. We've heard the stories.
It generally works never. Just so we're kind of narrowing it down. But let's unpack why it doesn't work, right?
Sure.
Just so people aren't like think we're just shooting down this concept. If it worked, we'd be all for it. That sounds awesome, right? Like I would love that. I love that. Here's why it actually doesn't work. It almost can't work, okay? Number one, the idea itself is great and wonderful, but if you're an investor, you hear a million ideas, right? Ed, you and I hear thousands of ideas, okay? I pay them no mind whatsoever. And that's not a disrespect out of the idea, but because I know better. I know whatever the version of the idea you're telling me it is now, it's going to change 100 times. I'd be more shocked if it didn't. And so when someone says, I have an idea, it implies that that's the final thing that's going to get produced and have product market fit, okay? That happens never. The moment you introduce an idea to the market, it changes a million times.
It's absolutely correct. And on top of which, let me just double click on what you said. Ideas are like a dime a dozen.
Yeah.
Will, and truth be told, we want founders to come to startups.com with all your ideas. Come with,
absolutely.
yeah, just your crazy moonshot ideas. I always say every founder's got a better than 0% chance of just completely finding that one idea that goes Airbnb, right? Yep. But then what happens is if you can't execute, and that's what investors are looking for, ideas without any form of execution, you're just throwing money into the void and hoping that it works. And investors just aren't built like that. And so because, like you said, investors see so many ideas, what they start doing is they start kind of upping the level of entry to say, now I need to see more execution so you can prove that you can do something with your idea no matter how good it is.
You bet. There's also a bit of a fantasy that I'm going to put this in front of one investor, and that one investor writes the whole check. Most people, because they've never done this before, I don't fault anybody for it. They don't understand that's actually not how investing works. If you're an investor and someone brings you idea, your first thing, if you like it, is like, awesome. Now bring me 5 more investors that also think it's a good idea. So yes, you may bamboozle one investor and make them think that this is such an incredible idea, but it won't matter because you have to bamboozle 5, right? Now, there have been some great cases where the bamboozling has been done. Theranos comes to mind. WeWork comes to mind. But those weren't someone with just an idea that just miraculously got money, right? Like people vastly undersell what those processes were to get there.
Let's talk about where having an initial pitch deck, even pre-product, pre-revenue, all that pre stuff is helpful. And I just don't want founders to build decks on hopium alone, but Will, you and I think we both agree that it's a great exercise to do a pitch deck up front, probably like an idea validation pitch deck, to at least articulate your thoughts, get it out there and in front of people for feedback, not expecting for them to write a check right away, but for you to battle test your ideas, wrestle with them, see what the market thinks, validate your idea. That is an exercise that we want all founders to do.
100%. And it's your job, our job as founders, to have exhausted every single thing that you can do without money. So even if money was coming, even if there's a chance that you might get a check, your job regardless is to first exhaust every single thing that you can do without money, which is part of what we're going to talk about.
Let's move on to the next thing, is the D tier. Build what an investor wants. Now, Will, we know founders, they can chase trends, but there's a particular type of startup that I recently came across, and it went like this. An angel investor has a bunch of money and says, I really want to build a startup like this. And then they meet a founder who could happen to build something. And then they say, yeah, I want to build this. I got the money. And then the founder says, okay, yeah, I'll build that for you. And then poof, startup is born. There's some mixed feelings about this. One, I say D tier because it's low effort because you don't have to come up with your own idea. You just have to meet the right person, know how to build something. That might have taken you a bunch of years to get a technical degree, but you also don't get to build your own thing. You're kind of like an employee. Sure, you're working in a startup. You're not working for a big corporation, but I've seen it happen. How many times have you seen it happen? What are your thoughts?
I'm going to give you another version where this happens, where I've seen it even more, which is, here's what I hear investors are investing in: AI, blockchain, you name it. And so I'm going to build a startup in that category. Now, to be fair, there is some wisdom to that, okay? Because as you know, and this is me discussing it to our audience, investors invest in trends and themes, okay? So if investors are specifically investing in AI or blockchain, et cetera, you will actually have a higher probability of getting an investment if you're in that chain or trend. However, that's not really what my concern is. My concern is when you meet with an investor, and the investor says, well, what you're really going to need to do is this. And then you go back to your team, like, everything has to change. That one person who just happened to have an opinion and spent 30 minutes thinking about our business made some off-the-cuff comment, and now let's change the whole business to suit that, right? That's what I see a lot of, and it's dangerous.
I know founders, thankfully and happily so, that heard from a VC, and they've said, we'll invest in you if you pivot to this or you embrace this audience. And I know founders that have said yes to that, tank their company, and it's gone all wrong. But then I also know founders who stood strong and said, that's not us. And they've actually turned into unicorns bootstrapped by not taking VC money.
Well, yeah. And look, part of it is when people go to investors, because they don't know who investors are, I went through the same catharsis myself. They give them way more credit than they deserve. Okay. They've got this feeling, well, they make assumptions that just aren't true. Well, investors talk to lots of startups. They invest in successful startups, so they know what works. Bullshit. Bullshit. Right? If that were the case, then 90% of their investments wouldn't fail. If they knew what works, they just wouldn't invest in bad companies. And yet, hark, guess what happens? They mostly invest in bad companies. They don't know jack shit. Now, that said, it doesn't mean they're poorly intended. It means they're not clairvoyant, right? When they say, hey, your business should do this, that is some person talking out of their ass. That's not necessarily somebody that has years and years of experience having operated this exact business telling you what they know.
What's the worst, Will, is when that investor, and they come across so authoritative, right? The way that they talk.
They're so sure of themselves.
Yeah, because it's the power dynamic, right? It's the golden rule. I got the goal. I'm going to make the rules. That's, you throw that weight around. But the investor that doesn't invest and then tells you what you should be doing to get the other investor, those are the worst. Case in point, Will, and I'm not throwing, I know you and I, we're not throwing investors on the bus. We're just throwing this dynamic, this situation that occurs. We're cautioning founders. But a founder came to me and said, you know what, Ed, I'm thinking about lowering my investment round from, I think they were trying to raise like 1.5 million or 2 million to like 500K. And I said, oh, that's interesting. Can you do something with 500K? Yeah. And I said, well, why did you try and go out and raise $2 million? He says to me, because an investor who didn't invest told me less than 1 million isn't worth it for that investor or anything like that. Like, this is the type of stuff that happens, Will.
Yeah, it happens all the time. I didn't know any better. I got all kinds of awful advice. And as I got further in my career, right, I'm 31 years into my career as a founder and CEO. And as each milestone happened, I started to actually notice this bad advice, like, more acutely. It's the same way your parents told you crazy shit when you were a kid, but you didn't understand how to process it when you were a kid.
Yeah.
It wasn't until you got much older we were like, what the, like, my favorite, this is Ed, this is my dad when I'm 11 years old in the 1980s, okay? He says to me, get off that damn computer and come watch wrestling. Okay. Now, when I say that, I look back on that damn computer is what like built my entire career. It made me millions of dollars, right? I was not going to be a professional wrestler, so that would have not gone well. But at the time, I was like, damn, Dad's probably dropping some knowledge right now. I should really pay attention to what he's saying, right? I mean, it is WrestleMania, Hulk Hogan, right? And so I think in the same capacity, when we're early in our careers as founders, we just don't understand how to process that advice, how to validate that advice, and in many cases, how to ignore it.
And that's why we're here, everyone, for you. Anytime, it's just an open invite. And I know Will's open to this as well. Any of you in the audience, any of you, you hear anything from an investor and you just want a second opinion, come and talk to us. Before you react, before you freak out, before you feel the pressure, come talk to us. We're here. We'll give you the goods. And what's the best part, Will, what I really enjoy is that I don't have the same incentive structure as other people might have. I'm completely agnostic. And I can just say, yeah, if that's for you, but here's the other opinions. We'll just give it to you straight up.
Yeah, it's incredible.
Let's keep moving on. Okay, so this is the D tier. So low effort and low reward. But now here's the C. And Will, we talk about this. This is get a day job. Okay. Now,
I didn't see that one coming, Ed.
Will, I put it here because so many founders, they'll put this in an F tier. They're like, no, that's not an option. Or they'll say, Ed, I came to you because I don't want to work my day job. I couldn't stand my day job, so I became a founder. But Will, there's so many benefits getting the right day job to allow you to build a startup on the side, create your own runway, become your own investor. Let's talk about all the virtues and then maybe where it could go wrong.
I think maybe if we distill this down a little bit and say, however you do it, what you're really trying to do is make sure you don't go out of business. I don't mean your startup. I always say that startups don't go out of business until the founder goes out of business. Because when the founder goes out of business, they can't pay their mortgage, rent, whatever, then you're really screwed. But if a founder, as an example, had unlimited runway, right? They lived at home with their parents and their parents were going to take care of them forever. Then in many cases, it's really hard for that business to truly go out of business because the founder can kind of, depend on the business, can run that as a one-man show forever. So when we talk about keeping a job, what we're saying is you have to keep yourself in business long enough to make the business work. And I'm a huge fan of finding different ways in order to keep the founders fed. We have founders that have bartending gigs. We have a gazillion founders that are doing consulting work, right? As they should. In the early days of Startups.com, we were building out our software. We didn't have a lot of stuff to sell yet, right? But we had a staff, we had bills to pay. And so what we did was we did consulting. We did consulting for fundraising and consulting for pitch decks. 13 years later, we still do it, right? We still do it because it makes a bunch of money, but we only got in that business because it was a way to supplement, income revenue for the company. until we got to the point where we could build product and have that do it.
Let's talk about some of these more precarious scenarios that we encounter. And I bring this up not to make it doom and gloom or, again, attack any founder in their approach. What scares me, Will, is that someone has a cost of opportunity. They've got bills to pay, they got a family, and then they really want to do this startup and they sink money, they sink time into it. And, they don't do freelance gigs. They don't drive Uber or anything like that. And they run it to the very end. And then by the end of it, they're desperate, saying, I might have to sell my house. I might have to declare personal bankruptcy. I've maxed out my credit cards. That's one of the scariest things, Will. Someone tells me they're chasing the dream.
Yeah.
And then they're living off their credit cards. And Will, that just creates so much downhill, it piles up against the founder, and it's not healthy.
Not at all. And so, again, Ed understands that getting a job sounds antithetical to exactly what we're trying to do. But here's what I say. You got a choice. Do you want to worry about running out of money or working at a job? You're going to worry about one of them. Which one do you want to worry about? I would rather worry about working on a job because I can manage my effort there and it's perennial. Like I know that I won't go out of business. The moment I switch to I'm all in on the business, which sounds great. And if you can pull it off, great. But at which point you're just watching the bank account dwindle to zero and you're like, I'm screwed when this doesn't happen. That's usually how it ends. And that makes me nervous for folks.
Let's talk about some of the advantages. And then I got a question for you, Will. One of the advantages is that one, if it's side hustle and you have that comfort, you don't necessarily have to react all the time. Right. And you just basically can say, hey, I'm going to treat this like I don't have all day in the world to do it. But you can kind of limit the parameters of what you're trying to do because you got limitations. Like it's just sometimes necessity is the mother of all invention. But then, Will, other times founders worry that they're just going to get comfortable. And we see this also on the other side where they spend all their time working on their logo and their tagline and getting the right domain name and building their business plan. And they never get going because they're comfortable working their jobs. How do you prevent yourself from kind of grinding your wheels or spinning in place?
Yeah, you know what it comes down to? It's not making dollars, it's not making sense. Meaning every single thing that you're doing, if it isn't directly tied to revenue, it's the least important thing you could be doing, bar none. Now, a lot of people don't like that answer. A lot of people are like, no, logo is super important. I ran an ad agency. We created logos, right? I'm a creative person. I love logos, right? No one has ever said, I really want that product, but man, that logo sucks, right? Like ever, right? We spend so many cycles on so much shit that revenue doesn't care about, and that makes me anxious. So, when I sit down with a founder and I try to help them because they've asked to kind of audit their time and their focus, I say, look, revenue is at the top. Nothing else matters. So, by the way, and revenue can come in many forms. When we go back to the story I just told a moment ago, how in the formative years of Startups.com, we were doing consulting, it's important for me to lay out what a project plan looked like on a week-to-week basis. And Ed, we still have a weekly project plan, right?
We do. Yep.
We never plan past Friday, not because we're trying to be short-sighted, but because we can't predict anything past Friday. So it also forces us to get something done by Friday. Anyway, back then, our project plan, our little Excel doc, if you will, had just a few categories. And it worked like this. Category number 1 was called revenue. Category number 2 was called product. Category number 3 was customers, which were more like complaints and support. And category 4 was operations. And it read left to right in order of importance. Meaning, if we were like, man, we need a really better HR policy. Yep, that's in operations. That's in category 4. We'll only get to that if we've gotten through all the other categories. The reason we did that is because it made every single person in the company, and every person was on that list and what they had to do for the week, accountable to revenue first. And it kept that top of mind and it worked beautifully.
Revenue first. I like that tip. We got a comment from the chat here. Let me just read this. It's got a good question. Add it. I started a company 34 years ago, 95% recurring revenue and profitable. Congratulations. That's you deserve kudos on that alone. I am lucky that is funding my startup. Awesome. And I love it. I love this story already. I also really love this founder, and I know who he is. And I'm using the same team to help on both companies. Running 2 companies is a lot of work, especially without having a co-founder share the responsibility. Ideally, I would find a buyer, take over the company, and continue to work for them with the transition. Any advice for someone in this position? Am I silly to give up that company that has so much recurring revenue?
I was in this position. I was in this position exactly. Let me tell you how it went. And I'll start with the punchline. Never kill the golden goose. Never kill.
Amen.
All right. So here's what happened for me in this case. In 2001, I launched this company called Swapalease.com. It's still around today. It allows you to transfer auto leases online. I have nothing to do with it anymore. And within like 18 months, we got that up to $3 million in revenue on $1.5 million in net income. right? And no investors or anything. This is just like literally pure startup, couple dudes in a room kind of thing. And I was like, damn, let's do that again. So I did. Started another company right after that, and we got that to 3 million on $1.5 million. So these are both running at the same time. And in all my wisdom here, I'm like, well, why not start 10 more of these? Right? Obviously, right? I had this idea that I was just going to build like a real estate portfolio, but of internet real estate. Right?
I hear you.
It was a sound concept. But that's where it stopped being sound. Now, if I could go back in time, right? We can't, but if I could, I would have stopped there. I'd have been like, I have one, right? I don't need to do anything else. Now to be fair, we don't want to grow like anything else, but like as soon as I started to make my life more complicated, I know this isn't the heart of the question, but bear with me. As soon as I started to make my life more complicated by starting a third and a fourth, and I'm running all these companies at the same time, just like you're talking about. What I'm saying is what I did when I started when I launched third company and fourth company and fifth company, et cetera, the last three being venture funded companies. So all three separately venture funded companies, I killed my golden goose, right? The businesses that were printing money that were just ATMs, I started to treat them as less important. Now we do that very easily because the new thing's sexy. Dude, you've been working the same thing for 31 years, right? Like the new thing's fun. But the moment you look away and you're not tending to that revenue, remember revenue first, you put yourself in a ton of jeopardy. Is it possible to hire somebody and take it over? That's exactly what I did. In fact, Ed, you met him at one of our founder groups the other day.
Yeah. I knew the story.
He's a great guy,
yeah.
Wonderful guy. Became CEO of that company, et cetera. I hired another friend, another great guy, became CEO of the other company, so on and so forth, right? It worked never, right? These are all good hires. They're good people. They went on to start plenty of other companies and be very successful. But there's a reason you're running it. There's a reason you're owning it. When you walk away from the store, so to speak, and let someone else run it, it is never the same. Are there stories where people did that and it worked? Of course there are. Of course there are. But be warned, if you walk away from the golden goose, the cost is extraordinary. Ed, what do you think?
I ran into the same situation. I did exit, made some money, and then I poured it in. And I've done this twice, Will, where I wish I would have known you or somebody would have stopped me and just said, Ed,
stop me. Yeah.
Your first exit is good enough. Just roll with it.
Yep.
But I kept rolling the dice. I kept reinvesting. And eventually the money from your exit runs out and you feel really crappy. Yep. And, it's like trying to catch lightning in a bottle twice. I've only been out to sell 2 companies. Now, Will, you've exited 5, which is a high proportion. I've raised for 7. I've only exited 2. If you really look at my track record, Will, I have lost more money for investors than I've ever made, right?
Well, I mean, that's one way to look at it, though, Ed. Another way to look at it is most people never get to one exit. Most people never start more than one company, right? When you start doing multiple things, the probability of all of them working goes down exponentially. If the likelihood of failure is 80% every time, then the more 80% you add, the worse it gets, right? That number only gets worse over time.
I'll tell you what I wish I would have done, going back, if we could retcon my history, I would have systematized it. And even if I made less and I got the freedom, I would have hung on to the asset because by that time, Absolutely. That's what it was. It was an asset. If it's worth buying, someone's going to buy it. It's worth keeping as an asset. So it's like get a day job is how we started here, but keep your day job is the second axiom. And Will, one of the stories, I went and worked for a family office and, what they ended up doing was systematizing their main golden goose and then moving on and branching out their things. And instead of going and working in those other companies, the owner, the main person up at the top, ended up just hiring people to do the other companies and explore, but kept their eye on the prize of the main thing. And that yielded literally tens of millions of dollars.
And it's nearly impossible to replicate. I've had lots of shots on goals with lots of companies. Some of them worked, some of them didn't. But I have no ability to tell you if the next thing I'm going to do, Ed, if you and I start a company right now, I have zero ability to tell you whether it's going to work, right? I wish I could, but the only thing I know now after 31 years of doing this is that I absolutely cannot.
I know, Will, we'd have a lot of fun, though. That's the important thing.
I agree. Yeah.
So let's summarize the answer. I'm saying if you can, hang on. There's obviously nuances to it, but don't quit your day job. Your version of that is don't kill the golden goose.
Don't kill the golden goose. I have no question that you're grateful for what you've built. It came across in your question. But the ninja move is to do whatever you can with that startup without messing with that thing at all. And in the moment that thing cries for help, that always gets the food first, right? As much as it sucks, and you're like, no, I'm going to do this new cool thing. It's got a bigger opportunity. Sure, it might. The only certainty is you already have a business that does make money. Don't mess with it. And I had a guy come to me, this is a few years back. We met up and he had built a consulting company that built mobile apps, okay? But he was a fairly young guy. He was like 26 and they already had up to 300 people on staff.
Whoa.
Right? Building, I mean, it's huge.
Yeah.
And he comes to me, this had to be 5 years ago. He comes to me and he's like, listen, I want to basically bet the farm in this new thing called crypto that I'm getting into, right?
Oh, no.
No, I know. And I'm like, I explained to him, I said, by all means, you're obviously you're your own person, make whatever bets you want, but don't kill the golden goose. He murdered the golden goose. Like, he didn't just kill,
man.
like, all those people lost their jobs. The whole thing went under like in record time. And he failed at the crypto bit, right? Like, he lost everything. And what's interesting is when you read stories of success, when you listen to podcasts or whatever, you are getting the top 1% best of filter of how this goes. Ed, you and I get to see everything else, right?
Yeah.
You and I get to see in the weeds when people are in their darkest moments. So I like to think, everybody's advice is biased, just like ours is, but I'd like to think that when we're offering this advice or some of the guidance, it's with the idea that we're trying to protect you. It's easy to say bet it all. It's really hard to say, dude, hang on a sec. Let's not lose our house over this.
Yeah, let's talk about incentives, Will. When that person is doing that podcast,
yeah,
they want everybody to feel like they can be part of that 1%.
Yeah, that's the idea. Yeah.
Will, you and I, we're the ones that are left with the pieces of the 99%. Every single day, we're talking to founders who, just the other day, one founder made $3.5 million a year, was making $3.5 million a year, huge profitability, darling of the industry, hears about this AI and says, oh, this is going to be the future, dumps $500,000 of their profits and operating cash from the golden goose into this, and now they got 45 days left of runway before everything shuts down.
Yep.
This is what happens, Will. And again, we're the ones talking to 99%, and that's why we want to make sure I have to go to bed at night, put my head on my pillow with peace, knowing that I've helped founders the right way, and that's why we're never going to pump you up and sell you a bill of goods just because we need to get attention or we're just trying to set up a mirage of something that's possible.
Tell like it is.
Let's keep moving on. This is a really great discussion. I'm having a lot of fun and I knew this would happen. So kudos. Thanks for the questions, everybody coming in. Okay, B tier. We've already talked about this. Start as a service. To me, this takes work, right?
Yep.
You have to kind of go think out of the box a little bit from what you're normally told, but it's high reward because you're working in the industry, you're learning from customers, idea validation, everything's lining up. And Will, you talked about making it a service, but we teach here, Will, that we believe that every startup, whether you're in B2B, B2C, could start off as a service. Unpack that for us.
Yeah, and when we say service, sometimes there's some nuance there. If you're like, hey, I want to sell cookies, right? What we might say is, don't take it all the way. Throw a party and sell some cookies. See if anybody gives a shit about your cookies before you go all in on this thing, right? And so a service is really what's the most fungible, immediate thing that we can do that allows us to get a feel for what it's like to deliver this product. And if we can, get paid right away, okay? So for example, when we were starting Startups.com, I mentioned we were building the software and the platform that you see today. But none of that was here. I mean, we were still building all that stuff. So we went out and we created services, consulting services for pitch deck, for funding, things like that. And we got paid on that immediately, which helped pay everybody's salaries so that we could go ahead and build what we have today. So we started, same thing, we started as a service. And I love that, Ed, because what's nice about starting as a service is you're not so married to how it's delivered that you're unwilling to change it. Conversely, you spend 9 months building a product and you launch it and it doesn't work, you don't want to change anything because you just put 9 months into it.
Painful.
You're more rigid.
Yeah, it's disappointing. When I did my second startup that I sold, it was an employee engagement, and I had this huge idea for this SaaS platform.
Yeah.
But I started off by consulting and doing employee engagement workshops.
Yeah.
And I sold workshops, and I literally went and I said, if I could show you how to do this, and it was literally my product process in presentation form. It was like a workshop. I said, how much would you pay? And they said $3,000. And I nearly fell off my chair, Will. I said, I'm in. Like, just, bring me for a day's work. They were going to pay me $3,000, Will, right?
Yep.
So, okay, that was good. And then I kept doing it, and I did everything manual. And for those of you who are familiar with Adobe Photoshop and Illustrator, I pretended that the software existed, and I created all my outputs, these graphs and, these network maps by hand, bleary-eyed, 3 a.m, putting it together, moving everything pixel by pixel. And I kept selling it till I bootstrapped $135,000. It all went to the bank because I kept my day job.
Yep.
And that I used for development. And though we have lots of stories like that, really fantastic stories.
You bet. And again, the service does a few key things. Number one, it allows you to get in front of customers immediately without having to wait for your product and get feedback, which most people don't do. The second thing that it does, it allows you to change your product. Here's a good example. When Startups.com was first starting 13 years ago, we were in the process of building what is now Fundable.com, which is our fundraising platform. And we had big ideas of what that could be. Okay. And the idea was you just go on Fundable, you'd list your company, and investors would follow the ceiling and give you money. What we missed was 99% of people that were coming to the site had no preparation or understanding of funding whatsoever. They didn't have a pitch deck. They didn't have a business plan back then. They had nothing. So they'd come to our site and they'd write like 3 sentences and they're like, and give me $1 million. Right. and it occurred to us that none of our customers were prepared to use this product.
Sure.
So we had to create a service, being like pitch decks and fundraising advice, et cetera, in order to condition our customers so they could use our product. And it turned out that was actually a real business. But it also turned out that giving people advice on pitch decks and funding and other types of advice became Startups.com. Right? That's literally what our business became, out of the services business, not out of the product business.
I'm very thankful because I call it my home.
Yeah.
Let's talk about B2C. We've had founders. I'm thinking about one in particular. You talk about cookies. She wanted to do like healthy granola bars or athletic things. And she was going to have to raise so much money. So she started off, I got pitch decks and all these things to get her first prototypes out there, the minimum order quantities, all that stuff, co-packer formulations. And it was Ryan, our co-founder here, chief marketing officer, said, hey, start off as a service and become like a health coach, right? And then find out if they'll even eat your, granola bars or whatever snacks, protein bars. And she went out and she sold a whole coaching lifestyle package, instantaneous revenue, takes so much of the pressure off. So like, that's our argument, that any B2C, if you get creative enough, you could turn into some type of service that gets you in front of your customers, doing something for them that they'll pay for.
Yep, 100%.
This is fantastic. Okay, continuing along. We are at the A tier. The A tier here, Will. And this is new, okay? What I'm watching these days, it's all about build the audience first. And let me tell you the story. We have a founder here, Startups.com. I advised her for quite some time. She went and she built an Instagram following of, I think, 2 million followers.
Wow.
And then said, hey, they're all asking for the same stuff. And then she came up with the idea and raised $6 million even before she built anything, because she had a built-in following. And I'm watching, Will, more investors go to like creators who have built-in audiences because they're saying customer acquisition cost is 0.
100%. Right.
They're right in front of their audience the whole time. So if we bet on this creator and becoming a founder and creating products, then we've got a better shot than someone who built a product and nobody cares.
You bet. And so investors can now invest in audiences first and products second, which is new because audience creation always used to cost a lot of money.
Yeah.
And now certain types of it still does. There's so many ways to create an audience right now with $0. We're making a YouTube video right now. That's gonna generate customers for us at $0, notwithstanding our time. That's incredibly powerful. And I think the idea of being able to go out there and build audience and test audience and learn the audience, et cetera, should be number one goal for everybody.
Well, you're sort of new to this whole creator economy, building an audience type thing. It's been a lot of fun, but you've embraced it, to your credit. Well, have you heard the latest about Mr. Beast's evaluation? He's actually raising money. Have you heard this yet?
I have not.
Okay. So Mr. Beast went from, I just make funny video game videos where I say Logan Paul like for 24 hours straight, to actually now I can sell products. So he started selling merch like influencers.
Yep.
Turns out Feastables, his chocolate company, makes $350 million a year.
There's no way Feastables makes
$350 million.
Whoa, it's not even that good. I've had it. I've got an 8-year-old son, so I have no choice but to eat it, and I want to like it. So this isn't me like trying to knock him. Ed, I saw that in like Beast Burger. I think he shut down Beast Burger.
Yeah, he shut that down.
Terrible. I'm not shocked that he made $350 million in revenue because of his reach. Again, underpins what you're saying. But anyway, I'm just reacting. Go ahead.
Yes, and his media company makes about $350 million a year, his videos, but loses money. Okay, so he just got the show on Amazon Beast Games where they awarded $10 million.
I heard it didn't do well.
He lost money on that, right? But here's the thing. They've got a CEO who's come in, and I believe that Feastables made $40 or $80 million profit last year. And they've got a CEO that's coming in and basically saying, we believe we can trim everything down and make the media company profitable by $100 million. They're raising money, and because they've got a pipeline, their valuation is pegged at $5 billion from a kid who made videos on YouTube.
Well, let's unpack that a little bit. So one of the things that's interesting is there's only one Mr. Beast. There is no number 2 to Mr. Beast. There's someone that has less views or whatever, but no one is even remotely close to him, right? Like he's totally on an island. He's a unique thing in the same way that Joe Rogan for podcasting.
Yeah,
it's just
exactly.
Joe Rogan, right? I mean, love him or hate him, he's his own world, like Howard Stern was back in the day.
Yeah, I remember.
Right? Like those guys are going to get exponential valuations because there isn't a number two. If you're number 57, you're not going to get anything close to that, right? Because there's so many other options there. But with Mr. Beast, he's the Taylor Swift of YouTube.
Yes, but I tell you what's happening. Recently, I believe that private equity put an investment into Dude Perfect, the guys with the Nerf guns and the trick shots.
Yep.
It was like $1 billion valuation. I heard inside, and I might be totally breaking the law here, but inside from, legal, that they're upside down. They invest so much into what they're doing, but they're able to generate their revenue. What I'm seeing, Will, is investors are now being savvy to audiences or built-in audiences. Yeah, and they're being more motivated to invest because of that. And that, I think, solves this conundrum of distributions fragmented and really hard for founders.
I agree. Pick your channel and go all in it.
Let's do it. All right, S tier. Will, this is really outside the box, but I caught this trend last year, and this is me being a little bit of a nerd theorist, I think it is, and saying that bootstrap in public. Now, let me pitch you on this, all right?
Hit me.
Last year, I saw founders, and one very successful founder raise a ton of VC money, build in public. So this is, I'm building something and I'm sharing my journey and all those things, and I'm building the audience. But then I saw him share videos of him talking to VCs, him, bootstrapping, trying to make ends meet. I know another gal, she's got a real cool social media startup. She put us out these Instagram posts, and she's in the influencer creator economy. But then she literally posts about her raising money and her journey and, her stretching every single dollar. And people were contacting her saying, I want to write you a check, right? And so to me, Will, this combines everything together here with being open, vulnerable, public about how I'm raising money, I'm bootstrapping my company. And I think investors are going to pay attention. I think it might be the S tier, like total, it could be the next thing, but it's not proven yet. What do you think?
I think it works for the right person. Okay.
Yeah.
So if you've got a creator economy style personality, right, that can deliver on that storyline, I think it works great. I think there's a lot of people that just don't have that charisma, and they don't have the ability to tie, hey, I can't pay my roommate rent with here's why you should like me. They're just very matter of fact. I just can't pay my roommate rent kind of thing. And so when we talk about building in public, what I have seen in some, and I want to reflect on some you and I did last week, what I have seen is bringing your customers into your product, into your company is really powerful. So a lot of folks don't know this, but twice a month, we host a community workshop, a private Zoom of our own customers, right? What we call community leaders, people who are our customers on our platform. It's weird, Ed. Until I just said that, we never call our customers customers. I just call them founders. It was the first time I've used that word in a long time. Anyway, because our founders are peers, so we don't think of them as customers. Anyway, but we do this call, and it lasts an hour, and everybody stays on the call. There's a lot of dozens and dozens and dozens of people in this call, right? And Ed, what blows me away is they care. They really care about what's going on at this company or what we're building next or what we're thinking. And so we've been very open about where things stand and where our heads are at. And I'll show people project roadmap and everything else like that. And they love it. It's awesome. What do you think, Ed?
That's a testament to you. There's two sides. One, we've got great, quote, customers, founders, friends, peers. Yeah. That's a given. And I can't thank them enough for being a part of our leadership. But two, Will, even though you're not out there publicly doing all this in public, you are transparent and vulnerable enough to go to our leaders and say, here's what we're building. You ask questions for feedback. They believe that, and rightfully so, that they can contribute in the conversation. So it's a two-way conversation that you created, Will, and I think that's what made it work.
That's interesting. Yeah, my whole thought is you guys are the ones that are buying the product, so to speak. So you are the subject matter experts, I mean, quite literally, right? Like, Ed, you can appreciate you've done this a million times where you're with your startup team and you're on a whiteboard and you're trying to talk about the future of what customers want, et cetera. And everybody has strong opinions about what the product should be and what customers want, et cetera. But no one stops to say, can we all agree that none of us actually knows? The people that actually know the answer aren't in this room. They're our customers. They're the people that are actually going to buy this thing. So in a case like that, where we get to be in that room with them, I'm a sponge, man. I'm trying to get as much information as possible.
Let's look at this tier list again, Will. Okay, so I ranked them just based on my preference. Remember, the scenario is I've got no money, I'm broke, and I need to get this startup up and running. And, for some want to raise a pre-seed round. I'm going to argue that if you do a lot of this, you won't even have to raise if you got revenue. But
great point.
If you had to rank all these or just pick your top one that you would recommend, what would you recommend and why?
I think the seminal one is Start as a Service. I think that is so underrated, and it's worth knowing most services businesses, like 98%, I made that number up, but I mean, it's probably not wrong. 98% of services business never raised money. Why? Because they didn't have to. Because they just charged money and got paid, right? Like my first business was an ad agency. It wasn't complicated. Like I build a website for you, you pay me money. It never occurred to me that I would have to raise money to do that, right? I was just like, I just need to sell more website. I was at lunch with a buddy of mine, another founder, a couple weeks ago, and I was on his board in the formative stages when he was building this consulting company. And he's like, Will, and he's teaching an entrepreneurship class. He wants some help. He's like, Will, I don't understand like all this raising capital stuff. He's like, I built my business to 80 million and it never occurred to me to raise money. And I was like, yeah, man, because you charge for your product on day one. The whole reason we raise money is because we don't have enough revenue to pay these bills, right? And I said, so focusing on revenue through service, whatever, is the move. What's your take? What do you think? What would you rank your top favorite?
Well, for me, after listening to you, I definitely think that starting as a service is sort of the quickest. It's the Occam's razor of everything. I'm all in on this theory, and you know me, I'm a creator economy, type person. For me, my S tier, Bootstrap in public, is it's a non-proven commodity. For me, I believe in something called being a channelpreneur. Hey, how about build some channels without even thinking about a product? Like go out and build it without trying to build it around what you're selling. Because a lot of founders hear this, they say, let's build community. And they go out and they say, I'm going to sell you this. So come into my community. And, customers are smart. They're wise to this. Like, I don't really believe that you want to do it. So I think that one of the interesting thing is, and we know founders will hear in Startups.com where I just look at them, I hear them talk, I see how they come across online during Zoom, and I go, you would make the best creator in the world if you paid attention, but they're too busy saying, no, I got to raise pre-seed money without anything. And to me, building that audience, I think is kind of like the hack for the next generation.
I agree. And the fact that the difference is, and you said next generation, because now you can do it. Truth be told, we couldn't have given this advice 10 years ago. 10 years ago wasn't that long ago, but the world was a lot different than it is now. You can be 13 years old and have 1 million followers, right? I mean, that would have been impossible in any generation since the beginning of time.
Yes. And therefore, I think every founder should be a creator in some form, use content marketing.
Correct. If you
and
can.
Every creator can become a founder. It's the new wave. All right, Will. So based on all this, what's your main takeaway and what's your final encouragement to anybody who's watched our discussion? This was really fun and stimulating, by the way. I usually think about this stuff in a vacuum, so it's nice to talk to someone about it. But what's your takeaway and what would you like to end off with?
My takeaway is, if you look at, kind of what the theme of these topics are, it's get money in the door first. Get like a customer money first, however you can get it, wherever you can get it. Also, money in the door includes a day job. That bartending gig or the server gig that you have right now, that's money in the door. That is revenue, whether you recognize it or not. Obviously, it's not the way you want to do it forever. I get that. But if it's a means to an end, and that end is keeping you in business so you can do what you're trying to do, then it's perfectly worthwhile.
We are here, everyone, to talk to you about all those options. If you're here in Startups.com or you're out there on the interwebs, share this. Like, comment, subscribe. We appreciate it. But you know what? I'm curious. I'd love to hear from any of you out there. If you're doing any of these or you've got success you want to share, other than, the Hopium pitch decks, we get this all the time. We're going to help you with that as well. But we're here for you to have that conversation. And I know Will is an open book. He'll tell you all the stories all day long.
Yep.
That's it for us today. Just want to go back over Tuesdays. We got pitch decks coming up. It's going to be great.
Pitch deck reviews. Yep.
And then Wednesdays, we do traction hacking, revenue acceleration. And then Thursdays, we'll have more topics, fun stuff. It's kind of like a guilty pleasure, this Thursday conversation. Well,
I know we just get to get stuff out of our head, and it's cool that people sit around and listen. We appreciate it.
And again, that's it for us. Thanks everyone for participating with us. Will, always a pleasure. I'll see you next time.
Until the next one. See you guys.